Hey everyone, welcome back to Big Markets Think Simple. You've probably heard the chatter lately. Is the EV boom actually slowing down? Does that mean battery makers are in trouble too? Here's the thing. If you look at LG Energy Solutions' recent numbers, the company looks like it's holding steady on the surface, but underneath, it's burning. Strip out U.S. government subsidies and the company's actually losing money. Meanwhile, factory utilization keeps sliding. So what happened here? And more importantly, can LG Energy Solution pull through this? This isn't going to be another EVs will bounce back so LG will too story. Instead, we're digging into the bold pivot LG Energy Solution is making, one that goes way beyond electric vehicles. Today, we'll walk through how this company grew into a giant, what's tripping it up right now, and where it's betting its future. Let's get into it. This video is not investment advice. It's for educational, entertainment, informational purposes only. I'm not a financial advisor. Please do your own research before making any investment decisions. Any investment decisions are your own responsibility. So what does LG Energy Solution actually make? Batteries. Think of a battery as a packed lunch of electricity. You store power ahead of time so you can pull it out whenever you need it. You can't just plug your phone, EV, or robot straight into an outlet and run in real time. So you pack the electricity into a box first and use it on demand. And just like lunchboxes, batteries come in different shapes and different fillings. Shape-wise, there are three main types: cylindrical, like a AA battery; pouch, thin and flexible, like a Ziploc bag; and prismatic, a rigid rectangular can. Cylindrical cells are easy to mass produce and durable. Pouch cells are light and space efficient, packing in more energy. Prismatic cells are stable and easy to handle. Then there's the filling, the cathode chemistry inside. NCM, nickel, cobalt, manganese, packs in a lot of energy so you get longer range, but it's expensive. LFP, lithium iron phosphate, is cheaper, safer, and longer lasting, but stores less energy, meaning shorter range. And solid-state batteries, the next big frontier, swap liquid electrolyte for solid material, aiming for even more safety and efficiency, though they're not yet ready for mass production. LG Energy Solution has built its business on pouch type plus NCM. China's CATL and BYD, meanwhile, dominate prismatic plus LFP. One company makes the premium, expensive lunchbox, the other makes the cheap, practical one. Keep that rivalry in mind. A lot of today's story comes back to it. So where does this electric lunchbox end up? The obvious answer is electric vehicles. EVs swap the engine for a motor and the gas tank for a massive battery pack, essentially a giant lunchbox bolted to the floor of the car. EV batteries are exactly where LG Energy Solution grew the fastest, supplying automakers like GM, Stellantis, Honda, and Kia. For car makers, the battery is the heart of the vehicle. It determines range, charging speed, price, and safety. Second, there's the small device market: smartphones, laptops, power tools, e-bikes, and increasingly humanoid robots. Third is ESS, energy storage systems. Think of these as massive battery warehouses that store solar and wind power for later use. With AI data centers gobbling up electricity at an explosive rate, demand for reliable power storage is surging. In short, LG Energy Solutions batteries touch nearly everything that runs on electricity, from daily gadgets to the infrastructure powering the future. But here's where the story takes a turn. LG built its early reputation and its fastest growth through 2023 almost entirely on EV batteries, and that's exactly the market where cracks started to show. LG Energy Solutions' story didn't start as a crisis, far from it. From 2021 to 2023, the company looked like the poster child of the EV boom. Automakers worldwide were racing to go electric, and batteries were the one thing they couldn't do without. LG Energy Solution was right at the center of it. Revenue jumped from $13.3 billion in 2021 to $25 billion in 2023, nearly doubling in 2 years. Operating profit grew from $590 million to $1.63 billion over the same stretch. Picture a restaurant suddenly flooded with customers. Big names like GM, Stellantis, Honda, and Hyundai Kia lined up, and LG rushed to build a bigger kitchen, new mega factories across North America and Europe, plus a wave of new joint ventures with automakers. North America in particular was LG's biggest battlefield. The U.S. government wanted to build a domestic battery supply chain, and automakers wanted secure local sources, so LG teamed up with GM on Ultium cells and expanded its North American footprint with Honda, Stellantis, and Hyundai Kia. Then in 2024, everything flipped. Revenue dropped 24% to $19 billion and fell further to $17.5 billion in 2025. What went wrong? High interest rates, pricier EVs, and vanishing government incentives made consumers pull back. Automakers cut orders and delayed or canceled contracts. North America took the hardest hit. GM sold off its joint venture stake, and LG's business with Honda and Stellantis shrank significantly. Add falling raw material prices and a weak European market, and the damage piled up. Factory utilization fell from 73.6% in 2022 to just 47.6% in 2025, like building a 100-seat restaurant that's barely half full. Fixed costs like rent and payroll don't shrink just because fewer customers show up, so profitability took a direct hit. Here's the strange part. LG Energy Solutions still posted $960 million in operating profit in 2025. Sounds fine at first glance, right? But strip away the $1.22 billion in U.S. government production subsidies, AMPC, money paid for making batteries on U.S. soil, and the company actually lost around $222 million. 2024 tells the same story. A reported $422 million profit turned into a $666 million loss once you remove subsidies. Over the last 5 quarters, 4 came out in the red without government support. On paper, the company looks profitable, but strip away the subsidies and the core business is struggling to make real money. The factories built on faith in the EV boom have turned into a cost burden. So why did this all hit the EV battery business at once right now? The global EV battery market is still growing fast, from 297 gigawatt hours in 2021 to 1,187 gigawatt hours in 2025, nearly a 4x jump in 4 years. But look closer and the picture gets uncomfortable for LG. China is both the world's largest EV market and its largest battery manufacturing hub. CATL and BYD alone captured 55.6% of the global EV battery market in 2025. CATL's share alone, 39.2%, is more than 4 times LG's. LG Energy Solution barely has a foothold in China, and even outside China, in LG's core markets of North America and Europe, Chinese manufacturers keep undercutting on price. As a result, LG's global market share dropped from 20.3% in 2021 to 9.2% in 2025 and 8.7% in 2026. LFP batteries are at the heart of this shift. LG Specialty, NCM, is expensive but delivers long range. China Specialty, LFP, is cheap and safe, and Chinese manufacturers keep improving its performance, closing the gap while staying affordable. Cost is another widening gap. China controls over 80% of global battery production capacity, with production costs more than 30% lower than North America's. CATL, meanwhile, has maintained an operating margin in the high teens year after year. LG makes LFP too, but Chinese rivals are already well ahead in this category. The U.S. government has slapped tariffs on Chinese batteries and EVs to protect domestic players, but that shield only works if North American EV demand actually recovers. So LG Energy Solution has come to a hard realization. Betting everything on EV batteries alone isn't going to cut it anymore. LG Energy Solution is now chasing a new path, and the biggest bet is ESS, energy storage systems. If EV batteries power a single car, ESS powers entire cities, factories, and data centers. As AI data centers multiply and devour electricity, stable power storage has become mission critical. LG is fast converting idle EV production lines into ESS lines, including its Michigan plant and part of its Tennessee facility, previously run with GM. It's like a restaurant with an empty kitchen switching up the menu to bring in new customers. The results are showing. ESS revenue share jumped from under 10% in early 2025 to the mid-20% range by Q1 2026. LG landed a $4.4 billion megapack deal with Tesla, plus major contracts with U.S. utility DTE Energy and Q-Cells. The second bet is the 46 series cylindrical battery, a next-generation cell, 46 millimeters in diameter, built for higher energy density and output at a lower manufacturing cost. As of Q1 2026, LG secured over 100 gigawatt hours in new orders, pushing its total order backlog past 440 gigawatt hours. Beyond cars, it's now supplying humanoid robot makers too. The direction looks promising. In Q2 2026, revenue grew 24.8% year over year to $5.55 billion, and the real loss, excluding subsidies, shrank sharply from $300 million in Q1 to just $96 million in Q2. But realistically, this pivot is still in its early innings. ESS is growing, but Chinese rivals are fighting hard on price, and converting production lines isn't cheap. The 46 series is promising, but still in the mass production validation phase, and the robotics and services business remains small. LG Energy Solution has found a new path, but it's far from a shortcut. Back in 1992, LG chairman Koo Bon-moo saw a small battery sample at a UK research lab and glimpsed the future. 34 years later, LG Energy Solution is fighting through Chinese price pressure and slowing EV demand, searching for its next chapter. If ESS, the 46 series, and the robotics push all pay off, LG Energy Solution could transform from a pure battery maker into a full-fledged sustainable energy company. But that road isn't easy. It's all about time and execution. If this video helped, hit subscribe and like. See you in the next one. Thanks for watching.